All right, so we are doing a question from September 2020. Uh, this is one of the past paper of the strategic business reporting. We are going in the section A, question number 2. First of all, we are going to read the requirement. Okay, what is the requirement? Discuss how Calibra company should have accounted for the sale of the apartment blocks in accordance with the IFRS 15 revenue from the contracts with the customers and IS 23 borrowing cost. Now, this is the good news that examiner has specifically stated you the standard that, okay, you need to explain the treatment according to these standard. So what you can do is just bring in your mind the relevant accounting treatment. And what you can do is when you're reading a question, you can just brainstorm what you are supposed to write in the answer so that when you are writing, all those relevant things are coming into your mind. There may be some questions in which the examiner is not going to tell you which standard is going to be applied over here. They just give you the requirement, advise the finance director how to deal with the particular transaction. In that case, you need to guess yourself which standard is going to be applied. But here, the good news is that you already know that here we are going to apply IFRS 15 revenue from the contracts with the customer and 23 borrowing cost. So 5 marks. You are supposed to write according to the 5 marks. And the pattern remains the same as I've already explained it to you, that what you are going to do is, first of all, write the lines from the standard itself, write the content of the standard, and then relate it with the case study. So you will be writing, okay, IFRS 15 describes the following treatment, particularly relevant to the standard, and then you just relate it with the case study. Okay, then we have provide the accounting entries. Like this is something the student want to get rid of during the studies. That, okay, sir, are we supposed to remember the journal entries, double entries, accounting entries? So yes, you are supposed to remember that, because in the SBR exam, you see this is right in front of you. Examiner is specifically asking you to write the journal entries. So provide the accounting entries that would be required to record the contractual sale of an apartment block on 1st January 2008 at a discounted amount over the 2-year construction period. So that means you're supposed to perform all the general entries related to that. The C requirement is discuss the way in which the chief accountant should have acted to ensure that he maintained ethical standards in dealing with the issues described. Now, we know that in the section A and in the question number 2 of the section A, we have the ethics part. So ethics is related to the fundamental principles of ethics, the ethical threats, professional behavior, integrity, competence, and due care. So just remember these things, that whatever the question relevant to the ethics is, you're supposed to relate it with the ethical principles and the ethical threats. So you should have those things in your mind, that the ethical thing is about, professional behavior. Let me just write it over here. So it's professional behavior, integrity, competence and due care, confidentiality, and objectivity. So professional behavior is laws and regulation, following the laws and regulations and avoiding action that discredits the profession. Integrity is about to be honest and straightforward in all business and professional relationships. Competence and due care is maintaining skills and knowledge to provide the professional services. For example, if you are not aware of anything, you should not get involved in those things, or first get the skills and then get yourself get involved in those things. Confidentiality is not to disclose the information without prior permission, and objectivity is to be unbiased, impartial, and do not allow influence of others on your professional judgment and professional decisions. And then we have the ethical threat, which is self-interest threat, self-review threat, advocacy threat, familiarity threat, and then we have the intimidation. So let's read out the question, and remember the A requirement is pertaining to the IFRS 15 and IS 23. So whenever you're reading a question, just make sure that you have the standard in your mind. And then we have the general entries thing. Calibra company operates in the property sector and has invested in the new technology, distributed ledgers, blockchain to trade and to support property transactions. The financial year end of Calibra company is 31st December 2008. Now we need to know the year end because we are supposed to perform the journal entries according to that. So when the year is ending on 31st December, we know that it's a common sense thing. It is starting on 1st January. So 1st January 20x8 to 31st December 20x8, because they were talking about the 2-year transaction. So that means 1st December 2009 to 31st December 2009 as well. Apartment blocks. Calibra company builds apartment blocks, which normally take 2 years to complete from the date of the signing the contract. Okay, so it's a 2-year contract. We know that the performance obligation will be satisfied over the time. It's a long-term contract. The title and possession, the title means the legal ownership, the possession means the control, and therefore the control of the apartment blocks pass to the customer upon the completion of the construction. So that means we cannot record the revenue. This is the common sense thing. You are studying this thing from your F7 exam. In the SBR as well, that you cannot record the revenue once you have transferred the control to the buyer. So because your performance obligation is not satisfied, unless and until your performance obligation is satisfied, you won't be able to record the revenue. The price which is payable on completion of each apartment block is 9.5 million. Okay, this is the amount you get when you complete the project. Alternatively, okay, the other option is the customer can pay 8.5 million cash on the day that the contract is signed. That means the customer is paying right at the start of the contract. This is the second option. The first option is they pay 9.5 million complete on the completion and the transfer when there is a transfer of the control. Alternatively, they can pay 8.5 million in advance. The chief accountant has calculated that this represents an appropriate borrowing rate of 6%. Now we know this thing, that when we are getting the payment in advance, this represents the financing component described within the IFRS 15. And we know that whenever there is a financing component involved, you need to discount it. Like what it is actually, you are supposed to discount it based on the number of years being involved in it. Because, for example, if you will be receiving the revenue by the end of the contract, you will be receiving another amount. And now you're receiving the amount at the start of the contract, that is another amount. So the IFRS 15 says that there's a significant financing component involved in it. And you need to record the revenue based on the present values, because the amount you're getting now will be different from the amount you will be getting at the completion of the contract. So the difference between these two represents the interest cost. The chief accountant has calculated this represents an appropriate borrowing rate of 6%. Calibra company immediately recognizes 8.5 million as revenue if customers pay when they sign the contract. So they are actually doing the inappropriate accounting treatment, because they cannot record the revenue at the inception or the start of the contract, because they will be transferring the possession and the control at the end of the contract, which is after 2 years. So this amount that they are getting represents the financing component. And what you can do is you record the cash, which is 8.5 million. Now, the accounting entries are quite simple over here. So accounting entries are quite simple. If you just remember what to do over here, you are supposed to debit the cash which you are getting, and that is 8.5 million, and credit the obligation and the liability, because this is the income received in advance, which is known as the deferred income. Income received in advance, or the deferred income, and deferred income, we know that is a liability. So this 8.5 million, what you are getting in advance, actually represents the financing that you are having to construct the asset. So what you will be doing, that you are already recording a discounted amount, and then you will be recording the financing component, interest cost, which is accruing on this 8.5 million. So according to the IS 23, whenever you are having a loan arrangement to construct a qualifying asset, now qualifying asset can be anything which takes substantial time to get ready for use. So here you are constructing the building blocks, apartment blocks, and that will take 2 years, and you are having the financing for it, 8.5 million, which is being given by the customer itself. So what you will be doing according to IS 23, if the loan is being taken to qualify to construct a qualifying asset, the interest cost should be capitalized. The interest cost which is related to the construction period should be capitalized. Now the double entries are going to be, what you're going to do is debit the asset which is currently your inventory over here. Asset, this is your inventory, because you will be selling those building blocks. So it's your inventory, because anything which is being sold in the ordinary activity of the business is called inventory. And credit goes to the obligations. The liability will be increased, obligation or the liability, whatever you call it, will be increased. So this is going to be the double entry for the first year, December 2008, and this figure will be added to the total liability. Again, in the second year, which is from 1st January 2009 to 31st December 2009, you will be having the same double entries. Again, debit asset, debit asset, which is the inventory, and credit goes to the obligation. You can calculate it yourself. We can calculate it right now as well. So this is again the second year entry, and in the third year, sorry, by the end of the second year or the start of the third year, probably it is going to be the end of the second year. So in the end of the second year, what you are going to do, you are going to de-recognize your full liability, and you will be recording your revenue when the control is transferred. So these are the double entries that you need to show to the examiner. And now over here in the A requirement, you just need to tell the examiner that according to IFRS 15, revenue should only be recorded when the performance obligation is satisfied. The performance obligation will be satisfied over a performance obligation will be satisfied when the control is transferred, which is at the end of the 2 years. So accordingly, the entity should not record the revenue now. They are getting the 8.5 million in the cash, which represents the significant financing component. Any interest accrued on it should be recorded according to IS 23, which states that if the loan is taken to construct the qualifying asset, interest cost should be capitalized. And this is how you're going to write for the examiner. Now, I'm not writing it myself because I expect you to write it for me, and then I'll be checking your answer. So the A requirement is discuss how the Calibra should account for the sale of the apartment blocks. We are done with it. So this is how we are going to explain for 5 marks, sufficient for it. And then we are done with the other 3 marks as well, which is going to be the journal entry. So 8.5 million, and then the interest thing, which will increase the liability, 8.5 million into 6% thing. So anyways, going towards the other paragraph, chief accountant and Bodani company. The chief accountant does not hold a permanent employment contract with the Calibra company. All right. He has applied for the position on the permanent basis and is to be interviewed in the near future, right? Okay, Bodani company, a customer of the Calibra company, wanted to take advantage of the 8.5 million reduced price for an apartment block, but was having problems with the cash flow, right? The chief accountant therefore allowed Bodani company to pay 8.5 million and to delay the payment until 1 month after the contract was signed. Now, you know, this is something unusual happening because they have 2 ways. Either they take the cash, 9.55 million at the end of the contract, or they take 8.5 million at the inception of the contract. Here, he's allowing them a 1 month credit period. In return, okay, what in exchange, what he will be getting, Bodani company has agreed to provide a good employment reference. You know, like the chief accountant is currently not permanently employed and is yet to be interviewed, so he needs the references to get employed permanently. Bodani company is actually saying that if you delay for us the payment 1 month, we will be giving you the favor back in terms of the reference. The chief accountant of Calibra company was afraid that he might lose Bodani company as a customer and referee if he did not agree to delay the payment. So that means he is giving an unusual favor. So, you know, this compromises the fundamental principles of integrity, that is to be honest and straightforward. It also compromises the professional behavior, because that complies that you need to follow the policies of the company, you need to be unbiased, you need to be impartial, and again, he's acting in his self-interest. Is the self-interest, right, that he will be getting in exchange the reference for the permanent employment. This is for the part C. Distributed ledger technology. Calibra company has recently used distributed ledger technology to sell shares in property to investors. These digitalized transactions are only visible to the authorized parties. Okay. The chief accountant publicly supports this technology and is to manage the new system, which is the blockchain technology. All are fine. However, he has private concerns over the reliability of the due diligence carried out on the sale of the property shares and the potential violation of the local regulations. So he has actually concerns that this actually new arrangement, which is the new blockchain technology, will result in the violation of the local regulation. When we are using that blockchain technology, that will result in a violation of the local regulation, which is against, again, the professional behavior principle, because following the laws and regulation and avoiding action that discourages the profession is professional behavior. The directors of the Calibra company want to increase the number of transactions on the distributed ledger by offering digital shares in the whole of the entity's property portfolio. Although the chief accountant has very basic knowledge of the distributed ledger, he has assured that the directors that he can facilitate this move. So, he has a very basic knowledge. He does not possess the competence. He does not have the expertise. He does not have the experience to deal with it, but he is ensuring the directors that he will be doing that thing for them. So this is against the principle of the competence and due care, that if you do not possess the competence, knowledge, and ability to do that thing, so you should not get yourself involved in it. The project has been approved by the board despite the chief accountant's private reservation. So that means they are just allowing themselves to breach the regulations, to get involved in illegal activities, which is being supported by the chief accountant. So it is again not something ethical. The chief accountant is only recently qualified as an accountant and wishes to employ with the Calibra on a permanent basis. So he's doing anything to get himself employed for the permanent job. So in this C requirement, you're going to first of all talk about the professional behavior, that according to the fundamental principle of ethics, professional behavior is following the laws and regulation and avoiding action that discourages the profession here, and then relate with the case study. So, and then other thing, competence and due can explain that and then relate with the case study. So this is for 10 marks. So that means you're supposed to cover each and every point over here. So this is how you are supposed to attempt this question in the exam.